Well, thanks for watching, and hopefully you've been reading our deep dive series. This time we're looking at American Airlines. Most of us are familiar with American Airlines, but just for those who are not, it's a flag carrier based in the US. It's actually the largest carrier in the world by fleet size. It's had its issues with profitability in the past, as have most flag carriers. Generally speaking, the only profitability in the airline industry comes from the low-cost carriers such as Southwest and Ryanair in Europe. Now, overall here with American Airlines, we're neutral on the stock. We have a hold rating with a $15 12-month price target. We've based this on going through the gold standard DCF analysis as well as a comparative valuation. So getting to the good, the bad, and the ugly, I suppose, to borrow a Clint Eastwood analogy. The good so far, which has been further confirmed by earnings today, is that demand is strong. So revenue growth is good, revenue growth is strong. And as well as that, margins are still holding up. So in the face of a strong inflationary environment, American is still able to maintain its margins and grow its revenues, which is important. Now, the bad is that we are probably facing into a US, if not global, recession, and consumer sentiment has already fallen sharply based on that. So that eventually will follow through to demand, but we feel not until probably 2024. Now, the ugly is American has a bad history when it comes to its debt pile and has needed government bailouts in the past. So it doesn't have a good track record in that terms. And with rising interest rates, that could be a problem with its considerable debt burden. Overall, though, we expect demand to remain strong, and in fact, American can maintain margins and revenues going into 2023 with such strong pent-up demand. We're forecasting that demand will hold strong despite rising costs in terms of inflation and oil, as Americans should be able to push those costs through to consumers and maintain current demand levels. We saw earlier on today that United Airlines forecast problems with oil prices, but we actually don't see that as big an issue going forward. In fact, oil prices are now below where they were before the Ukraine conflict began. And if you look at the oil futures curve, it's actually forecasting oil prices to fall in 2023 based again on a global slowdown, global demand falling based on a global recession. So overall, we've used, as mentioned, two valuation methods to come up with our $15 price target. Our relative valuation method and our DCF method were both tweaked to account for shrinking multiples as the US economy enters recession. This is where we differ a little bit, I suppose, from a traditional Wall Street analysis, which will just focus clearly on a DCF multiple or a price earnings multiple and get a price target accordingly. But we think the macro environment and the re-rating is important to take into consideration here. So we've probably taken about 20% off our price target based on the fact that in a bear market and in a US recession, price earnings ratios generally fall by about 20 to 25%. Technically as well, then we've added in a little bit of technical analysis. I'm just going to share my screen here, which again gives us a little bit of support to our $15 price target. So if we just look at the long-term chart here on American, you can see this kind of pandemic lows, which correspond nicely with the strong trend line in place, which dates all the way back to the global financial crisis. So this is the July 08 lows, tested again multiple times in 2009, tested again in 2011, and then again, once again, after the pandemic. So there's a series of sharp lows, all of which have bounced off this trend line a considerable amount of times, adding to our comfort, I suppose, that having a 12 support level is this high volume bar here, showing that there's quite a lot of equilibrium price at that level. Buyers and sellers have done a lot of buying and selling, I suppose, at the level, and price discovery is high at this level. So generally, if price discovery is high, that indicates a level of equilibrium or a level of support and stability. So that's generally where we find ourselves. We have a $15 price target, as I said, and hopefully you've found these articles useful and you'll consider reading more of our deep dive series. Thanks again for listening, and thank you for your continued support.